Hello and welcome to ET Now. You're watching IPO Central, and the company today in focus is TruAlt Bioenergy. Its IPO is opening on 25th and closes on 29th. Price band of 472 to 496 is a IPO with primary issue of 750 crores and a offer for sale of 89 crores. So the total size of the IPO is 839 crores, and the company is valued at 4,253 crores at the upper end of the price band. And joining me today is Mr. Vijay Nirani, who is the managing director of the company. Vijay, thank you very much for joining us on ET Now.
Thank you so much for having us, sir. So the 750 crores, out of which around 172 crores is going for capital expenditure, and this is going for one of our plants is getting converted into a dual feed from a mono feed. So meaning we are adding grain-based processing capacity as well. That's 172 crores there, and about 425 crores of working capital requirements, and the rest is GC, general corpus.
You're one of the largest producers of ethanol in the country with installed capacity. Give us a sense of the kind of market growth that you see in this market and the kind of challenges that you also face with respect to the frequent government intervention with respect to conversion of sugar into ethanol.
So we see a bigger opportunity in biofuels. Of course, 1G ethanol is the first vertical wherein a lot of revenues for us currently is coming from. Taking a step back, we also have multiple other avenues, that is compressed biogas. In the near future, we want to get into sustainable aviation fuel, all of those. Now, if you look at the current 1G ethanol space itself, the policymakers have actually driven this very fantastically. That's why our 10-year goal of achieving 20% blending, we could as a country achieve it in less than 5 years. Now, I agree there was some policy dilly-dallying on use of sugarcane juice and BHB molasses last year in FY 2024. These were more on a panic-based decision where they reduced use of sugarcane derivatives but had increased the maize prices at that time, and they promoted maize usage at that time. So what we ended up doing is considering this, the optionality that government has to promote different feedstocks in different year of time. We decided to convert 3 of our 5 units into dual feed. So thereby overcoming this challenge that potentially the government could on policy dilly-dally.
What is the kind of current capacity that you have for production of ethanol, and when you're converting 3 of your 5 plants into dual feed, what is the kind of is there an additional capex that is required beyond what you're raising in the IPO?
Yes, sir. So currently, my installed capacity as of March 2025 was 2,000 KLPD or 20 lakh liters per day, of which 18 lakh liters was operational for that for the last financial year. Currently, we have commissioned or completed all the 2,000 KLPD, and that is being put to use as we speak. That said, the grain integration we are doing, or dual feed integration we are doing across 3 places. So one of the places we are doing it using the IPO proceeds. And in the other 2 places, we have done it using debt and equity, and those plants are also nearing commissioning as we speak. So, as of October 2025 onwards, we should have a fungible 1,300 KL and a gross 2,000 KL of capacity.
What is the kind of total debt that you have on the books there?
At gross levels, my debt currently is at around 1,180 odd crores as on date, and of which there's about 240 odd crores of working capital limits. My term debt, however, is around 940 odd crores broadly, and interesting part is my entire debt is covered under a interest subvention scheme of the Government of India, where 50% of whatever the banks or the lenders are charging on me is subvented through this interest subvention scheme on a quarterly basis. So my applicable rate of interest becomes 4.5%.
And how do you plan to bring down this leverage, and till when is this interest subvention scheme applicable for you?
So the scheme is applicable for a period of 5 years out of the life of the debt, that is 7 years. Now, our intent is to not close this debt because it's the cheapest source available in the Indian dynamic ecosystem, right? The cost at 4.5%. So we are going to equity markets to raise working capital instead of raising working capital through debts. Through dilution of equity, we are raising working capital because this interest subvention is not available for working capital. It's only available for term loans, which is why it is imperative for us to continue this term debt, which is costing us only 4.5%.
Okay, so once you come near to the repayment, you may, or the tenure comes to a close, you may close this loan, and and you'll have enough cash flows to manage that kind of debt repayment.
That is correct, sir. So because these are reducing balances on a yearly basis, so each year my repayment itself is somewhere around 140 odd crores. In fact, last year at 1980 crores of revenue, we had a free cash flow of almost about 260 odd crores, and which covers more than what is required for my repayment on the maturities on yearly basis. So by the time my 5 years are over out of the 7 years, the remaining 2 years, the quantum of the debt itself will be considerably smaller. So servicing full rate of interest on it as well as repaying that debt wouldn't be, I mean, it wouldn't be challenging for us.
Can you also give us a sense of the kind of long-term supply agreements that you have for your ethanol?
Yes. So Government of India, rather the oil marketing companies, came around this policy of an LTOA and a non-LTOA. So LTOAs are long-term offtake agreements which are executed with, say, ethanol plants or dedicated ethanol plants. And they are usually for a period of 10 years from the day of signing. And for us, it was 3 years ago, and when we signed. So typically, we have another 7 years of the tenure on the long-term offtake agreements.
Okay. Also, give us a sense of, the government is also now, while you're doing, ethanol blended petrol, the government is also looking at blending for diesel as well through isobutanol. Are you also looking at that opportunity as well?
Yes, definitely. So we will be geared to take benefits of that. Because converting ethanol, or rather the wash that we have, into isobutanol will only require some additional distillation columns per se in order for us to get into or divert ourselves into isobutanol also. Now, isobutanol is a very light compound, so potentially getting into that is a considerably easier opportunity for us as compared to a greenfield plant operator.
Okay, and does it require additional capex, or is it it could be a brownfield expansion that could bring in that additional capacity for you?
It will be a brownfield capacity itself, but there will be certain capex that will be required, because we'll be adding certain equipments like the distillation columns and the evaporation modification, the evaporation columns and things like those. But yes, as compared to doing it on a greenfield basis, the capex here will be much, much lesser.
Your existing facilities are all located in Karnataka, which is a sugar belt, but are you looking at setting up more facilities in other sugar belts in UP or any Maharashtra?
So as of now, sir, the ethanol capacity for us is at peak. So 2000 KLPD, we have no immediate plans to increasing the capacity just yet. We will wait for the policy to pan out beyond E20. That said, our second business vertical, the compressed biogas, is expected to be set up across multiple locations in Maharashtra as well as Karnataka. We are also exploring this opportunity to see Bihar as one of our potentials, where we operate one sugar company through a promoter group company. So that could be one of our other areas for diversifying.
So that would be a related party transaction if that happens. What is the kind of related party transaction that you have for sourcing of sugar, sugarcane, and other materials?
So this is the advantage that TruAlt carries, that is the access to raw material through our group company. Now, our group company is scheduled to give us the materials like sugarcane syrup or molasses. For them, by them diverting up to 25-26% of their gross crushing capacity, TruAlt can run up to 200 to 250 days for its raw material requirement. That said, the engagement between TruAlt and the group company is on a arm's length market price driven basis. The MSA is for a period of 10 years again. And the pricing is benchmarked onto, it's driven by a formula which takes FRP as the base case scenario. FRP is the price that Government of India declares. Now, TruAlt also has this opportunity because it's fungible with capacity right now, meaning it can take different kinds of grains as well as different kinds of, sugar derivatives as well. So we have this potential to operate on multiple raw material.
Vijay, how is the pricing mechanism? Is it entirely dependent on how government is going to price ethanol or ENA, or is it you have a different arrangement with all your customers, even including the OMCs?
So there are two brackets. One is the public sector undertakings, the OMCs, and then we have the private oil marketing companies. So the public sector, the OMCs have a price that they declare before the beginning of each ethanol supply year. Typically, it's worked out between the policymakers as well as the oil marketing companies. And once we get that price, our only objective is to supply the quantity that we hope to, or rather we wish to supply to them. So this happens through process of bidding.
Okay. Can you also give us a sense of the kind of margins that you are sitting on, and how do you expand that kind of margin?
So currently we have been seeing a growth in the EBITDA percentage year on year. So last year my EBITDA was about 188 crores on a revenue of 1200 crores at about 15% last to last year, that is. And last year, that is in FY25, we saw growth in EBITDA by almost 1%. And in terms of revenue, in terms of number on EBITDA, was almost about 306 crores as against 188 crores the year before that. So we are continuing to increase both the revenue as well as the bottom lines. Even PAT has grown almost 5 times from 35 crores to 140 crores. This is possible by by securing the raw material at the cheapest available price. So that helps us build the margin.
Okay. And is it possible for you to increase this margin beyond 16% to closer to 20%, or is that the nominal level of margins for you?
I wouldn't say it's impossible, but going upwards of 16 to 18% should be possible if I secure the raw material when it's at its cheapest. Now the delta in the RM price is as high as 20 to 25% in a calendar year. So this is for rice and maize, I would specifically say, or even for molasses for that matter. So if my raw material is priced, let's say 15-20% cheaper than the normative price, or rather the median of the whole year, then we end up making a larger margin.
Give me also a sense of the kind of revenue seasonality that you have, because you have around the year supply for ethanol for the OMCs. So will there be a revenue seasonality also which comes in, because the sugar crushing season is in the second half of the year and goes into the first half of the calendar year, right?
Correct. So as discussed, I was saying earlier, we are integrating 3 of our 5 plants into dual feed. So 65 to 70% of my gross capacity is dual feed, meaning it can take different kinds of grains or sugarcane or anything. So going forward from Q3 onwards, we should see a stable operation for all the quarters. Q1, Q2 usually we have 2 months of downtime, especially during the monsoons. We take a scheduled maintenance of the plants, and then starting from Q3, Q4, and Q1 we should have a strong operating cycle. So at least 300 days in a year is our target to operate it at 90% capacity.
So you're saying that in Q2 the revenue hit would be there because of the scheduled maintenance that you undertake. Is that what you're saying?
That is it. That is right. That is right, and it is as per the industry norm for monofeed plants.
Okay, Vinay, it was a pleasure talking to you today. Thank you very much for joining us on ET Now. Your IPO is opening on 25th, and closes on 29th. It values the company at little over 4,200 crores at the upper end of the price band. Thank you very much for joining us today on ET Now.
Thank you so much. Thank you so much.